And now an extended conversation with Edward Yardeni. He's Yardeni Research, definitive at C.J. Lawrence a few years ago, a long tour of duty, a must-read at Prudential-based Securities, and has been one of the true bulls of his roaring 20s. Ed Yardeni, how roaring are our roaring 20s?
Well, I think things are looking better ever since April 9th, which was the postponement of the so-called Liberation Day. And then, of course, on May 12th, there was another postponement of the tariffs on China. And so the stock market's had a V-shaped recovery since then. And the stock market's had a kind of a roaring 2020s correction, followed by an amazing recovery.
Let me translate the modesty you just heard there, folks. Ed Yardeni defined bond, equity, currency, commodity vigilantes. Ed Yardeni, the vigilantes spoke, didn't they?
Absolutely. It was on April 8th, the day before the postponement of the tariffs, that the bond yield basically went up from 4% to 4.5%. That got the attention of the administration, freaked them out, actually. And even the president acknowledged, verbally said that, that the bond market's reaction to his policies led him to postpone the tariffs. He subsequently denied that, but he said it. And it's pretty clear that he had sort of a Bill Clinton moment back in the early 1990s. James Carville and Robert Rubin warned Clinton that he had to have fiscal discipline. Otherwise, the bond market would come and get him. And that's exactly what happened to Donald Trump on April 8th. And then he reversed his policy, or postponed his policy, on April 9th.
Ed, we still have, even though some of these tariffs have been rolled back, we still have tariffs that are well in excess of kind of where we started the year here. How does that impact economic growth, inflation? How do you kind of factor that in these days?
Well, first and foremost, I've been observing and predicting a continuation of the economy's resilience. It's been, over the past 3 years, we had the most widely anticipated recession of all times that never happened. It was the Godot recession, the no-show recession. And now and that was in expectations that the tightening of monetary policy would cause a recession. We argued that that might not be the case. And now, of course, the whole tariff turmoil has got people thinking that we're going to have a recession. But those recession odds have been coming down, at least in the part of the consensus. And that's because President Donald Trump has blinked several times on the tariff issue. But as you said, it's still there. It's just not as onerous as it was when it was initially announced. But it does mean that we're probably going to have a bout of stagflation for a few months, where the economy looks somewhat weaker in the summer with more inflation.
So, Ed, given that background, how do you think about this whole allocation, stocks, bonds, alternatives? Kind of where do you see the best opportunity these days?
Well, I've been bullish on this market since November of 2022. So we did call the bottom in October, and it's hard to tell people to jump on board of this speeding train right now. I would just stay invested in the stock market, and I continue to recommend avoiding information technology, communications, industrials, and financials. So I would stay with the stock market for sure.
Right. The ambiguity here, I think, is absolutely profound. And the basic idea here is we have a global lift in yields, whether I look at UK gilts, I look at the real uncertainties in Japan in that. And what's so hard in the modern media is to understand the zeitgeist is higher yields are bad. Push against that.
Well, higher yields should be bad, but they haven't been bad. We have seen a global bull market in stocks, even though we've seen bond yields increase. Now, my view is that to a large extent, bond yields have normalized. They're back to where they should be. 4.5% is the right bond yield for the U.S. economy. That was the case before the great financial crisis, and I think it's the case against now. maybe we're getting some excesses in the UK and some excesses in Japan. But if you want to be U.S. centric, which to be, I think these bond yields are kind of normal. But I do see a risk that there could be a mini debt crisis, the way there was in 2023. And in some ways, Tom, I hope there is, because I think now's a good time for a debt crisis to get the attention of the politicians in Washington, that they got to get their act together.
Ed Yardeni with us, Yardeni Research. We welcome all of you in your commute across the nation. Good morning, Bloomberg 1130 in our global Wall Street. Good morning, I should say good afternoon in England and the city and in Paris as well. Thank you so much for tuning in on all of our audio products. And of course on YouTube, subscribe to Bloomberg podcast. Ed Yardeni's dog on the couch.
The research assistant.
Subscribe to Bloomberg
Subscribe
podcast.
to Bloomberg podcast. Okay.
Yeah, Max, I got a note from Max.
Okay.
The dog looks stressed, Ed. I mean, if I look at the dog, I mean, the tension in the market's really affecting Max, right?
Max really keeps me calm. He keeps me grounded. Sometimes he puts me to sleep, but
he's in charge.
Paul says that about me too.
Exactly. Hey, yeah, you mentioned a debt crisis. I mean, I've been in this market since the mid '80s. We've been talking about deficits and the national debt, and it just doesn't matter. Is
really
what
important
I've kind of.
point.
Yeah.
Can you give us some context there?
Yeah, absolutely. Back in July of 1983 is when I concocted the term bond vigilantes, and I went back and read what I wrote, and I said the bond vigilantes are particularly upset about record $200 billion deficits. And here we're looking at $2 trillion deficits and talking about the bond vigilantes once again. Behind me, I have a bookshelf, and
yes, you do.
On the top shelf, I've got a bunch of books from the 1980s, debt bomb, drowning in debt, all kinds of end of the world kind of scenarios with debt. And here we are, and stock market basically at an all-time high. So the end of the world hasn't occurred yet. And you have some very smart people like Ray Dalio basically arguing that it's imminent, that we're going to have a debt crisis, that we might have a buyer's strike.
This is important. I'm taking Paul's territory here, but it's just too important. When people give you the doom and gloom, isn't that the time where you acquire shares? That's what John Templeton would say.
Absolutely. It's when your gut hurts and you just want to get out. Tom, I have to brag. I have a really good track record at calling bottoms more so than tops. And that's because I have a relative that I don't speak to too often that always called me at bottoms and said, Eddie, should I get out? All of a sudden we're best friends, it's when your Uncle Max calls you up and says, I know you follow the stock market. Should you get out? That usually makes the bottom.
Ed, what do you make in where investors should be positioned in a fixed income market here? Because you can sit at a 2-year Treasury and make darn near 4%, or do you go out there and take some credit risk?
It's kind of weird, right? Credit risk used to be high yield bonds, corporate bonds. Now, suddenly we're all worrying about the 30-year Treasury in Japan, the 30-year Treasury in the United States. So I would stay short for now, but I think there could be a really great opportunity to jump back into the bond market. The 10-year could revisit 4 3/4, 5% here pretty shortly if the bond vigilantes are not pleased with what they see coming out of Washington. And if their view is the big beautiful bill is actually the big ugly bill, we'll know that pretty quickly.
And one of the new areas that's been just seeing amazing growth on global Wall Street in the last 15 years or so has been private credit. How do you think about that when you talk to your clients?
Well, I don't know. I like securities. I like to buy securities where there's a liquid market and I can get in and out and I know what these things are worth. I really don't have a problem with private credit, but I wouldn't overdo it there.
Right.
I get a little suspicious when I see that the private credit industry is starting to become very democratic and create ETFs that allow them basically to unload the bad stuff
Right.
into ETFs. So I think they've had a good record, but I'd be careful.
And Yardeni, just one final question here, and I think it's really, really important for there's Standard & Poor's 500. How does Ed Yardeni find a select group of stocks within the Standard & Poor's 500 to believe in? Is your method like free cash flow? Is it more economic based, almost a Schiller analysis? How do you go about choosing the security for the long run?
Well, first and foremost, we don't pick individual stocks. That's not our forte. So we basically tend to provide an opinion whether we think the stock market's going to continue to go up and which sectors within that are likely to perform. So I think the short answer is, yeah, it's based on the economic outlook. I started out on Wall Street as the chief economist of E.F. Hutton. And then a few years later, I became also the strategist at C.J. Lawrence. So it's sort of combining the two disciplines that guide my work on sectors and industries. You know, we've liked in information technology, we've liked semiconductors, and they've been one heck of a roller coaster ride. But basically, it's been a profitable.
What's your SPX call here, year end or even out 12 months?
Well, you know, I've been doing a lot of work on that, and I just want everybody to know that the DXY dollar index is a very misleading index. It's a fixed weight index. It's not a trade weighted dollar, and 57% of it is the euro. So you might as well just look at the euro dollar exchange rate when you're looking at DXY. I like the MSCI organization actually puts out a daily trade dollar, which is almost identical to what the Fed does. And to me, the dollar remains on an upward trend. To me, the dollar is going sideways relative to developed economy currencies, but in terms of emerging markets, the dollar is very strong. So I'm not in this, end of the world scenario for the dollar.
Well, give me the Standard & Poor's 500. Are you out to 7,000 still? Have you reaffirmed that off of all the tariff news?
Well, I started out the year at 7,000, and I think strategists were generally kind of near that kind of level. Maybe I was at the high end, and Trump got me. So I did lower it to 6,400 in early March, and then in late March I lowered it to 6,000.
Well, I got to make some news today. Come on, can you give me 7,000 here on a sleepy May morning?
I'll give you 6,500, which is what I've raised it to, with the possibility of getting back up to 7,000. But I've told people I reserve the right to change my mind as often as the president does.
Max just rolled over when he heard that. We said good morning to Max on the couch. For those of you on Bloomberg Radio, the dog is casual here on a May morning. Ed Yardeni, thank you so much. With Yardeni Research, again, we protect the copyright of all of our guests' research. Go to Yardeni Research. It's a terrific value. Can't say enough about the use of it off your cell phone.